Hey guys, welcome to today's stream. I'm going to give everybody a moment to join. I've just sent a link into the Discord. I apologize for being 20 minutes late or so today. I've been having issues with my PC or my internet, one of the two. So I've been trying to start the stream for ages. Generally, my PC is pretty good. It's quite powerful, and so it usually handles a whole different load of programs at any one time. Today seems like it was getting overheated for some reason, so maybe it's time to upgrade some parts of that. Today's session is all about understanding your Darwin, or otherwise known as our Darwin explanation session. And this is where we go into some of the more in-depth, complex topics and concepts around trading at Darwinex Zero. It's where we look at things like value at risk, the risk engine that we have, and so on and so forth, and actually looking at what a Darwin is. I think sometimes it gets overlooked in terms of what people think a Darwin is and how it acts. And so that's the kind of thing that we cover today. So if you have any questions as we go throughout this session, no matter what platform that you're watching this on, whether you're on Instagram, X, or YouTube, please feel free to put a comment in the chat box, and I will go through the comments as we go through the session. Unfortunately, the Instagram comments don't come through, which is strange, and there's always one or two comments that I end up missing. So I will try and check them at the end. So if you just stick around, unless it's urgent, I will answer the question straight away. So let's dive straight in. JC, welcome back to today's session, dude. I hope you're prepared for a more in-depth session today, because this is more kind of theory or more complex theory, let's say, as opposed to the last couple of sessions that we've had. But glad that you're back here again. We must be doing something right, so I appreciate you turning up. My name is Kieran, and I'm head of UK growth and business development here at Darwinex and Darwinex Zero. And if you don't know who we are a regulated asset manager and also a regulated broker. We are regulated by the FCA in the UK, by the CNMV in Spain, and also by the FSA in the Seychelles. And we're currently working on getting our SISEC license also in Cyprus. That should be happening soon. We have over 100 million US dollars invested by third-party capital. I think it's roughly 109 million at the moment. By third-party investors in our platform. We also have our own investment through the Darwinex Labs prop desk, and also through the index, which is in the million range as well, within the few million range. And we have over 10,000 active strategies on the platform on both Darwinex and Darwinex Zero. We call them strategies because some traders have multiple accounts with us and multiple strategies. Our main job is to go out and find high quality, or in fact the best quality trading talent out on the market. And then on the flip side is to raise capital for those traders. So we have two sides to the business, where we try and scale investors, and we also try and scale traders and bring them together for a win-win ecosystem. Now, I actually need to add another slide in here, right? Because we start off with what's the point of a Darwin? But actually, one thing that I've noticed over the past couple of months is we really ought to define what is a Darwin. As I said at the beginning, if you was here when I first started the session, some people get confused as to what a Darwin actually is. And I think it's important to define that before we go into anything kind of more in-depth throughout this session. So a Darwin is a synthetic index based off of your trades. It's not an exact one-for-one replica, because we have a proprietary risk engine developed by Darwinex. I apologize, I keep touching my eyes. Something's in it, and it's bugging me. We have designed a proprietary risk engine that's been running with Darwinex for the past 13 years. And it sits on top, kind of a layer on top of every single strategy on our platform, regardless of how you trade or who you are. The risk engine is designed to manage risk on behalf of traders, on top of your own risk management as a trader, to ensure that an investor never gets the blowback from a trader, blowing up an account or going crazy. So it sits as an independent layer between the trader and investor, completely unbiased, completely neutral to how you trade. The risk engine does two different things, okay, which we'll get onto shortly, but it adjusts your position sizes and it manages the position if you let the exposure go on for too long. And I'll get into that later on in the session. So your Darwin is an index with your trades and our risk management. So like I say, it's never going to be a one-to-one replica for what you do. And the reason it's set up this way is because if you were to go and work at a prop desk or an investment bank, hedge fund, wherever you may go in a professional trading environment, you're always going to have a third-party risk manager. Now, that's somebody who may sit on your desk or sit in your office who oversees the risk of every single trader at that firm. If you start taking too much risk on a given position or exceed your limits, the risk manager is probably going to step in and either unwind your position or, come and have a stern talking with you. Of course, that's fairly easy to do when you're all in an office together and you have one person managing all of these different traders, right? When you have over 10,000 traders scattered worldwide, like we do at Darwinex, we can't employ a risk manager to go and sit with every single trader. It's just completely unfeasible. And I doubt there's over 10,000 risk managers in the world at a sufficient level. So the way we have it designed is an algorithm that runs 24/7 to act or as to replace having a risk manager. Again, we'll get more into the risk engine a little bit later into the session. But for now, I hope you understand what a Darwin is. Again, it's your trades plus our risk engine or our risk management. And that creates a synthetic index which sits under the Darwinex asset management license, meaning it is an actual investable asset that you can provide to an investor that they can allocate capital to in a legal licensed manner. Now that we have the definition out of the way, and I appreciate I probably dragged that out longer than I should have done, we can talk about what is the point of having a Darwin. JC said, just finished calibration, Darwin to be made on Monday, trying to absorb all information I can, thanks in advance. Perfect. This is a perfect time to attend this session then. If your Darwin's going to be created on Monday, it's a perfect time because this information is going to be fresh in your head and you'll kind of know exactly what to expect coming into Monday. Now that we've defined a Darwin, let's talk about what is the point of having a Darwin. Number one, it's risk adjusted by our risk engine. Now, this has many different benefits, but the main one being you completely understand your strategy to a new level, okay? Don't overlook that. Don't kind of try and see past the benefit of that. Understanding the inherent exposure or the inherent risk in your strategy will help catapult you. It kind of gives you a humble realization of actually how much risk I take to generate a return on a day-to-day basis. Because it's risk adjusted, because it's through Darwinex, you also come under our regulatory compliance. Again, meaning that you can take capital in a regulated manner. If you're like me, if you're in the UK, it's very, very difficult to handle investor capital to the point where it's pretty much impossible, especially if you're unlicensed, unregulated, and you don't have the specific qualifications that you need to be an asset manager. Because we have the asset management license and we create an index based off of your trades, it allows you as the trader to scale investor capital and get exposure to investors without having to worry about getting regulated, without having to get the relevant qualifications or the relevant licenses needed. And lastly, you get a proven track record. Now, this is kind of twofold because you get your risk adjusted track record, which is your Darwin, but also you can take your broker statements from Darwinex Zero, okay? Because although the account is virtual, although the account isn't live capital, it's still a simulated environment, okay? So that's a little bit different to demo. We run our accounts, even the simulated accounts, we run them on live servers, which means they have live slippage, live spread, live commissions, live conditions. So you're not going to get exact fills if you're trying to trade through NFP, for example. You will experience true market data. So even though you're trading with technically false funds or demo funds, you're still experiencing live conditions. Hence why if you connect your account to MyFXbook, for example, it will say it's live. Even though it's demo, it's on live servers. That's crucial because it's a whole world apart from opening a demo account with IC Markets, for example, where you kind of have artificial demo environments or conditions. You don't get that at Darwinex Zero. So, as I was saying, you have two different track records. You have your risk-adjusted track record, which kind of sells itself on the Darwinex marketplace, and you also have your broker statements, which are backed by an FCA-regulated broker, which is Darwinex, which means that if you're applying for a professional job at a professional desk, you can take your broker statements, and they know there's going to be no fugazi. They know that there's not going to be any messing around with trades or faking trades, so that you can kind of get ahead. They trust it, meaning that track record kind of becomes your CV as a trader. Whereas if it's from a dodgy broker that's got 1 out of 10 star reviews and has no licensing or regulation, you never know whether the trades have been faked or manipulated in some way. Just to recap what I said about the fact that your Darwin is an index of your account and not just a one-to-one replica, this means that your MetaTrader statistics will most likely be different than your Darwin metrics. And the reason being is because you are risk adjusted. So unless you're part of the 0.001% who exactly trade at a value at risk of 6.5%, which I'll get onto in a moment, and don't get risk adjusted, then this will probably affect you. How much you're adjusted, I don't know without seeing your trades, without understanding how you trade. But just be aware, and this especially is relevant to people like JCID, whose Darwin is being created on Monday. You will notice your statistics change because after calibration, your account is risk adjusted by the risk engine, and therefore moving forward, you will be displayed your index or your Darwin metrics, which is what the investors allocate capital to. Now, our risk engine adjusts all of the traders' trade sizes on our platform to maintain a value at risk, or otherwise known as VAR or VAR, of around 6.5% per month across the board. Value at risk estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. It's a bit wordy. I know it's kind of like difficult to make sense of that. So we have got an example just so that we can break it down a little bit further. If a trader has a value at risk of $1,000, or in this case 6.5%, let's say, that means with a 95% confidence level over 1 month, it means there's a 95% chance that that trader won't lose more than $1,000 or 6.5% in a single month, meaning that the investor knows their maximum downside in any given month is 6.5% to within a confidence level of 95%. Okay, I know I'm probably throwing a whole lot of words here and it doesn't really make too much sense, especially if you're kind of new to markets and you're trying to dip your toes in professional asset management. However, what we're trying to do is mitigate downside for an investor when there's black swan events, traders blowing up, all of these different things. So essentially what we're saying is from the way that we manage risk and the way that the risk engine manages your trades when you're in the positions, we can safely say to an investor that only 5% of the time, or that's probably a poor way to word it, 95% of the time, or within a 95% confidence level, we know that you're not going to lose more than 6.5% in a given single month. It doesn't mean that the trader's not going to lose month on month and you might lose more than 6.5%. It doesn't mean that at all. But what we're saying is in a single 30-day period, you should not lose more than 6.5%. Although there is, that little wiggle room at the end, that 5%, because in markets, we can never say something for sure. Now, by us doing this, by us leveling the risk between all of the traders, it creates a level playing field, ensuring that every trader is judged based on their skill and not just the amount of risk that they're willing to take. So if you think of two traders who both take a position on euro dollar, exactly the same price, stop and target in the same places, and they manage the trade the exact same. But the first trader trades 10 lots and the second trader trades 0.1 lot. Obviously, trader A is going to make a whole lot more profit because they have risked more, because they traded with 10 lots. Does it mean that they're a better trader? Or does it mean they're just willing to risk more? Well, the risk doesn't really matter because we're taking care of that with the risk engine. So what we need to understand is how good is the trader that is sat behind that strategy? And from a risk-adjusted perspective, who can make the best return with the least amount of risk? That's how you truly can define who is the better trader out of 1, 2, 10, 1,000 traders. So what we're doing is we're trying to standardize the one metric that we can, whilst that, because drawdown is kind of, or downside is limited, right? Whereas upside is exponential. Okay, if your system has a max drawdown of 10%, for example, it's highly unlikely you'll ever go past that 10%. And when you do, you'll recover. And it's kind of like a temporary dip in the equity curve. However, the return is exponential, or at least should be if you're a high quality trader or a profitable trader, meaning that there's no upside or there's no cap on the upside. So we want to see who can take advantage of that upside without taking too much excessive risk, or at least having the same risk between each single trader. Now, you might be wondering why 6.5%, however, for value at risk. However, if you attend any of my sessions, which I know a lot of you guys come to, a few sessions a week, I bang on this all the time. And the 6.5% is the risk level of the S&P 500. So 6.5% value at risk is the S&P 500's risk level, which investors are familiar with and have proven to be familiar with and to tolerate that over an extended period of time. So essentially what we're doing is we're adjusting your strategy to a risk level that ensures it meets investors' expectations and risk tolerance. Now, this often gets overlooked by traders, especially traders who, here's a common issue that we find is a trader never trades their personal account. They don't do anything professionally. They get introduced to proppers or funding companies as they're starting the industry. They build their experience in this artificial environment where they risk 1%, 2%, 5% per trade, and then they come to Darwinex and they say, oh, you're taking my profit off me because you're reducing my trade size. They do not realize that an investor doesn't need 50%, 100%, 200% returns per week, month, or year. They'll be happy if they beat inflation, if they beat their bank's interest rates, and if they beat the S&P 500, and maybe other low risk or lower return investment opportunities like property and stuff like that. If you can beat all of those other avenues, then you will always pretty much gain investor capital. Now, what's more important is that the investor is comfortable sitting in that investment for a longer period of time. The last thing that you want is an investor to allocate capital today and get scared tomorrow and bounce because your drawdown's too big or the volatility is too big. We know at 6.5%, investors have shown us for the past 50 years that they're happy to sit through, bad periods, good periods, drawdowns. They're happy to sit through and they're happy to let their investment play out. So essentially what we're doing is we're giving the investor that same feeling of, don't worry, this is your maximum downside, very similar to the S&P. However, this trader should outperform the S&P. And again, there's a little bit of kind of like humbling truth or just saying it how it is. If you can't beat the S&P 500, there's no way you should be taking on investor capital, in my opinion. If you're a trader and you cannot prove that you can beat the S&P 500 or you can't beat inflation, or interest rates on a bank, there's no way that you should be handling investor capital, because an investor has safer investments with higher upside. Okay, so those are your first benchmarks as a trader. You don't have to flip your account. You don't have to make 100% in a week. It really doesn't matter. Keep your size low and just prove that over time you can beat all of these metrics, the metrics that an investor looks for. That's the disconnect when somebody comes in and complains that the risk engine might be scaling them down, is they seeing it from their perspective and not what an investor would want. Anyway, enough rambling. I'm rambling on loads about that, so we'll move on. So understanding your value at risk, I skipped this chart because I need to get rid of that. To be honest, it doesn't serve much purpose in this session. This is your VAR chart or your value at risk chart. You can find it on the strategy analysis tab on your Darwinex Zero dashboard. If you scroll down, you'll see this chart. Of course, you have to be out of calibration phase to see this. So when you're out of calibration phase, this will become available. Now, what I've done for the purpose of this is stuck a big fat white line on the chart where it says 6.5%, just so that you understand the risk level that we're adjusting all the traders to. Now, at the beginning, I should say this is a living, breathing, organic chart, right? So as your behavior changes, as your risk preferences change as a trader, this will adjust. So if you start reducing your exposure, your value at risk is going to come down. If you start increasing your exposure, your value at risk is going to increase. Now, you can see at the beginning, The trader was roughly 2x, 6.5%. Looks like they were trading about a 13% value at risk. At this point, the risk engine is going to be scaling their size back roughly by 0.5, so roughly by half. Now, what that means is if the trader's taking a one-lot trade or one contract on their MetaTrader, then it means their Darwin's going to be taking 0.5 lots. Okay, because the trader is double the volatility of 6.5%. And what we need to do on their Darwin is to bring that down by 50%. As the trader comes down, you have another metric called the risk multiplier, which is what takes your value at risk and relates that back to your Darwin. So, for example, the easiest way I can explain this is if you're operating at a value at risk of 6.5%, your risk multiplier is going to be 1 because you don't need to be adjusted. If you're operating at 3.25% value at risk, which is half of 6.5, then your risk multiplier is going to be 2, meaning it's going to scale you up by 2. If you're at 13%, it's going to be 0.5, and it's going to be halving your position sizing. Now, as the trader comes down, their risk multiplier is going to increase, their VAR's decreasing, risk multiplier increase, till they get to 6.5%, at which point they're probably going to be experiencing a 1-to-1 conversion of size, meaning that if they're taking a one lot on their MetaTrader, their Darwin will probably also be in a one lot trade. Now, as the trader goes underneath 6.5%, actually what the risk engine is going to be doing now is scaling their risk up. So as I said, if they're operating at 3.25%, they're going to be scaled up pretty much double, okay? So if they're taking a 0.5 lot position on their MetaTrader, their Darwin's going to be taking a full one lot. You can see this information on your dashboard. However, this is private to you, so you can only view your own Darwin Live Trades tab. And essentially what this is it shows you your risk multiplier and any trades that you're in with the current contracts or the current amount of lots that is exposed. This usually shows up on your bottom left-hand side of your screen. As I said, it shows your Darwin risk multiplier. So in this example, it's 2.32x, which means if the trader takes a one-lot trade at MetaTrader, their Darwin's going to be taking 2.32 lots. The current closure rate shows if there's any percentage of any of your positions that's been closed by the risk engine. Now, the risk engine, whilst you're in a trade, measures your deleverage and it keeps an eye on that statistic. If it exceeds a certain threshold within a certain time frame, it may close a small percentage of that trade because your exposure is growing. We have much more information on that on our website or on our knowledge base. Just search Darwinex Zero knowledge base, and we have a whole load of articles that explain this in real depth. I'm kind of giving you the overview of how things work, but if you really want to look at the maths and understand exactly what's happening, I would recommend going and reading those knowledge base articles. Underneath that, you can see it shows that this trader is in a Kiwi yen short position. They have 1.2 lots open on their MetaTrader, and they have 2.79 lots open on their Darwin because they have a positive risk multiplier of 2.32x. Again, going back to the trader A versus trader B example of taking the same position on euro dollar, the only difference being trader A trades with larger size than trader B. The risk engine is likely going to scale down trader A and scale trader B up to meet in the middle at the standard risk level of 6.5%, meaning that regardless of the position sizing and their MetaTrader accounts or their interactive broker accounts, their Darwin is going to be using the same exposure to get the return. Now, your value at risk depends mainly on 4 factors. However, I do split these out into 2 different factors because I think you can't categorize them the same. The first one are strategy-specific factors, which is 1, 2, and 3. So you have asset volatility. So, of course, every asset that you trade has a different level of volatility. Number 2, how many trades you take. And number 3, how long you sit in trades. This is very commonsensical. The more trades you take, the longer you sit in the market, of course, the more exposure you have to that market and the higher your value at risk. I don't ever recommend changing any of these to try and satisfy some urge to reduce your value at risk or to increase your value at risk. Your strategy is your strategy, and I think you should keep it as that. Only ever change your strategy if you see an improvement needs to be made, okay? The fourth one, however, which sits outside of your strategy, is your position sizing. you can very easily change your position sizing without having to change anything or without having to mold your strategy around Darwinex. So if you realize that your value at risk is too high, the lowest hanging fruit to change that is to reduce your position sizing. However, it's best to do it over a period of time because the risk engine has a 45-day look back period and a 6-month look back period. So what it does is it looks at your average VAR over the past 45 days and over the past 6 months, compares the two to ensure that you're not being over or under leveraged at any given time moving forward. Which means if you drop from 10 lots to a 1 lot straight away, all of like your average, it's going to take a while for your average to catch up, and your Darwin's going to be undersized for a period of time. So I would always recommend dropping your size slowly. So going from a 10 lot to a 9 lot to an 8 lot to a 7 lot, for example, and spending a good few weeks, if not a couple of months, making that transition. Only if you feel like it's necessary. Going back to the VAR chart, usually what we've seen here, bearing in mind Darwinex has been around for 13 years, so we've seen tens of thousands of traders over the years. If a trader has a value at risk of 30% plus, 30% or above, they have an exponentially higher chance of blowing their account or going through a significant drawdown that's just too difficult to come back from. And that's really important to note because 30%, it's very easy to hit that without realizing. So if your strategy is above 30% value at risk, I would recommend spending some time just doing some investigating into kind of the worst case scenarios. Run some Monte Carlo tests on your strategy if you can. If you have a back test, if you have live trading history, run it through a Monte Carlo system and see what the worst downside could possibly be. It's worth putting some time into investigate that because like I say, over the traders that we've seen, it's like above 30%. It's not guaranteed, but there's an exponentially higher chance that you're going to blow your account. If you're below 30%, happy days. Don't worry about it too much. So a few questions before we finish up. And if you do have any questions or about anything that I've covered in this session so far, please pop them in the chat because we will be tying the session up after these. So I don't want to miss any questions if you guys have any. So number one, when will my Darwin be listed? Darwins are always listed on the following Monday after you complete the calibration requirements. So regardless of the day of the week that you complete the requirements, it will always be created over the weekend, ready for the following Monday. Number two, should I stop trading whilst it's being listed? Absolutely no way. Any trade that you take on your account will be counted towards your Darwin, whether it's being listed, whether it's active, or whether you're in calibration phase. Every trade will count. And I actually don't recommend ever stopping trading. I think you should just keep trading. Like, people will stop trading to get an allocation or to secure their spot in the Darwinia leaderboard, which I think it's really easy to get sucked into, but think long term. Like, what you don't want to do is keep seeing periods of inactivity because, you know, in 2 years' time, when you've got a long track record and the Darwinia allocations are kind of less important because you have investor capital, you don't want investors to keep seeing this period of inactivity just because you were trying to get the best allocation or the highest spot on the leaderboard. I also think just have some conviction in your system. You need to take every single trade within your system to get a true representation of what you're capable of as a trader. And I just always think, just back yourself. Don't be scared of losing some profit or losing this, that, or the other. Just keep trading. Just keep doing it. It's easy to get pulled into that, but you know, it shows how strong you are as a trader if you just carry on trading through that. Number three, should I increase or reduce my risk? As I say, if you're 30% or above, of course, it's worthwhile sitting down and taking a look at that. If you're below 30% VAR, I wouldn't really be too concerned. Number four, how to increase my risk multiplier. I've explained this. It has an inverse correlation with your VAR, so you would need your VAR to drop to increase your risk multiplier. However, your Darwin's likely to come out the same result anyway because it's a self-balancing mechanism. So if you drop your size, your VAR is going to drop, but your risk multiplier is going to increase. So the Darwin still will come out the same result anyway. So don't get caught chasing your tail. Number five, is it bad to have a high or low multiplier? There's no bad or good really when it comes to the multiplier. Again, the only concern I have is 30% VAR or above. Again, you have an exponentially higher chance of blowing up your account, but there is no bad or good when it comes to your risk multiplier or your value at risk. Finally, I just want to say a massive thank you for all of you guys who have joined this session. JC, thank you for dropping a few comments at the beginning of the session too, dude. I appreciate all of you who turn up to these sessions and watch. I apologize for being a little bit late to this session. As I said at the start, I was having some issues with my PC trying to get the stream up and running, but we got there in the end. I am down in London tomorrow for an investor event. So my replies in the Discord will be a lot slower than normal. However, if you need anything or you have any follow-up questions, I'm going to drop my email in the YouTube comments. So please feel free to reach out to me via email, or if you're in the Discord, I'm always open for a chat, always happy to jump on a call. Please just drop me a message. My name is Kieran, Kieran-Darwinex. I have an orange tick. Make sure it's a real account of me. Don't message a fake spam account, because believe me, I have plenty of them. But like I say, I'm always happy to have a chat, always happy to have to jump on a call. And if you need anything, just please let me know. So guys, JC said thanks for that, very informative. I'm glad you found it informative. If you have any follow-up questions, dude, just please let me know. I'll be happy to answer any questions that you may have. So without further ado, guys, have a fantastic rest of your evening, morning, afternoon, wherever you are in the world. Have a great weekend, and I will catch you on Tuesday. I think Monday is a bank holiday in the UK. So we'll catch you all on Tuesday when we're back for the welcome session. Peace out, guys. Have a great weekend.